Welcome, everybody. It's 6 o'clock. This is a meeting of the Town of Stockbridge Finance Committee. We have a quorum this evening. And the first order of business, we do have two sets of minutes to approve before we call on our auditors to discuss the financial statements, the management letter, and the letter to the board. They will follow. The first set of minutes is a set of minutes of February 2nd. You will recall in those minutes that the committee suggested that a sentence be added to the minutes encompassing on an aggregate basis the finance committee with financial experience and governmental. That was done. Are there any other questions relative to that set of minutes?
I will move their approval.
Second.
Okay, so we have 2 minutes. Steve, motion, and Pam, second. All in favor?
Aye.
Aye.
Anybody opposed?
And I don't know if you got a full house tonight.
What's that?
You have a full house tonight?
Yeah, no, you have to vote. No, we don't. We have one on vacation. I don't know what happened to Belfans. So that would be 6-0. And missing Belfans and vote is on vacation.
It's unusual for him.
Okay, the next set of minutes is March 2nd. That you'll recall, we discussed the budget. The one issue in that set of minutes, one question came up, was the comment that was made about the 2.5% cost of living. That cost of living, just as a clarification, would be a permanent adjustment to salaries. And the question also was raised by Bill Vogt. Is it enough? Michael, do you want to say anything else on that at this point, or would
Not
you?
in minutes, but we'll be discussing.
Okay. Are there any other questions relative to the March 2nd set of minutes? There being none, can I have a motion to approve?
So moved.
Second?
Second?
Okay. And all in favor?
Aye.
Anybody opposed? No. Okay, we're fortunate to have our auditors, Adelson and Company, with us this evening. We have David Irwin here, who is the partner in charge of the account, if you will, and Joe Collins, his associate. And I would call on you, gentlemen, the materials, the financial statements, the management letter, the letter to the select board, the drafts, have been circulated to this committee. Okay, so I call on you to.
All right. Okay. So I have 2 extra copies of the audit here. Let's see.
Thank you, Joe.
I have an extra copy. Did you want one?
I've got my,
Are you okay?
That's all right.
Okay.
if it's extra, I'll take it.
Okay, good.
Thank you, sir.
Yeah, sure. All right. So
Or better never than white. Do you understand that one?
Okay,
okay. So we completed the audit for the 2022 year. James, you got a copy of the financials?
Yeah, I think so.
No.
I don't.
Take 2.
Oh, yeah, I didn't print that one. Okay, that is not.
Document, okay. I promise that I won't go over all the pages.
Right.
Okay, so we wrapped up the audit for the 2022 year. So if you want to turn into the financial statements to the independent auditor's report, it's the same auditor's report as the prior year, except we have a reorganization of just the paragraphs. So up top, we now have our opinion first, and we issued a clean opinion over the town's finances. So no material weaknesses, no significant deficiencies, no findings. Your financial statements accurately represent your financial position at June 30, 2022. Okay? So, and the letter goes on to point out our responsibility as your auditor, that we got to comply with auditing standards and government auditing standards. And then it goes on to point out that there's also certain information that's required to be included inside your financial statements, such as the management discussion and analysis, and certain information on the pension system and the OPEB benefits that you provide to your retirees. And all of that information is included, just as it has been in the past. So good thing, clean opinion for the 2022 year, okay? So we're gonna bypass the next page 6 series, which is the management discussion and analysis. It's required to be included in there, but we're actually gonna go over the information that's inside this report by looking at the numbers. So let's bypass the 6 series and go right to page 7. So this page 7 is a statement of net position. We got 2 bases of accounting that's inside your financial statements. Page 7 and 8 is the full accrual basis of accounting, where you're required to have these statements inside your financial statements in order for us to express an opinion. Full accrual basis of accounting, different from the accounting that we do here at the town, is if you buy a capital asset where you budget, that would be an expense. Where under GASB 34, that capital asset gets put onto the balance sheet and gets amortized or depreciated over its useful life. We're required to put all your debt on the balance sheet, and we're required to recognize your proportionate share of the retirement system, which is an estimated liability, and we're required to report the town's approximate obligation, which is based on actuary calculations of what we promise our retirees for paying health insurance when they go into retirement, okay? So that's the primary difference from what we do with local accounting, which you'll see in page 9 and 10. So starting at the top, we ended the year with $10.4 million in cash, $2.8 million in investments. The investments that we have is in Bartholomew, it's held by them. So the sum of those two numbers is about $13.2 million. So I know we don't have the prior year here, but cash and investments is about 1.8 million more than the previous year. Now, one of the biggest reasons for that is we had borrowing come into the fiscal 22 year, which we did not spend the bulk of that money by June 30. And that was about $1.5 million. So when you factor that in, cash is really up only about 300,000, okay? Your receivables, we have $1 million in receivables. That's broken down into 2 components. About 530,000 is owed real estate, personal property, and motor vehicle taxes. Town does an excellent job with collecting its taxes. We got a 99% collection rate on the real estate tax commitment for the 2022 year. We got a 98 or 99% collection on the personal property. And we even got a 95% collection rate on motor vehicle excise. So that's actually very good. Usually motor vehicle excise taxes are really, between mid and high 80s. So the fact that you got 95%, town does very, very good in regards to collecting on its taxes. So that's a good positive. The other $500,000 that's in the receivables, we had some cost reimbursement grants. So we had the receivables recorded on the books so we could record the revenue to offset the expenses that we incurred by June 30. And we saw those payments come in July and August. So those have since been collected. So long story short about your receivables, all considered collectible, no issues. Now we have this non-current section. We have a net pension asset, okay? We belong to the Berkshire County retirement system. And we have to recognize on the balance sheet our proportionate share of that pension system. So the pension system goes through an actuary calculation done by PIRAC. We get a copy of that report, we look at it, do minimal testing over it, make sure everything looks fine. And then we record your proportionate share out of that actuary's calculation onto your financial statements. Based on the actuary calculation, for the report that made it into our financial statements here, because they're on a calendar year, right, Joe? So they're December 31, 2021 year, yes, which is following into our June 30, 22 year. They actually had a total projected obligation less than the total assets that they actually have. So that put the pension liability into a net pension asset, section 4. So we have it up in the assets now.
May I ask a question about that?
Oh, yep, sure.
Because that was a September 30, 2021
Yep.
report, might that be particularly influenced by the market in 2021?
Oh, yeah, absolutely.
Which
Yep.
2022, a year later, could be very, very different.
Yeah, that's spot on. I agree 100% with that. So when we get the actuary report done by PIRAC for year end December 31, 22, which will fall into our June 30, 23 financial statements, you might see that net pension asset pushed back to a net pension liability. That's a very, very good observation. That's exactly right. Now,
I have a quick one for you.
Sure.
On this net pension asset, if you will, is the accounting, refresh my memory, is this done on a town by town line item basis? Is that how the Berkshire County retirement
well,
depicts it?
so you have the retirement system is actually running their calculations for all the communities and all the
Correct.
individuals that are inside that system. So it's one set of financial statements for the system as a whole, but they do break that liability down by community. The underlying base for that entire transaction is payroll going into it. So that's how our relative proportionate share is derived. That's because that's the underlying base.
I just want to be
entire
sure we're on
calculation.
the same.
No, and that's exactly right.
Yep.
Now, we have a net pension asset. There's other pieces to that calculation that interact with the long-term actuary's projection of what the total OPEB obligation is. So that drives these items called deferred outflows of resources and deferred inflows of resources, which we record in two separate spots on your balance sheet, which I think is ridiculous. I think we should just have one number, but GASB says we got to do it this way. But anyways, probably the easiest way to explain it is the deferred inflows and outflows are connected with the long-term the long-term projection of what the total OPEB obligation payouts are to the retirees, okay? They take that, they discount that back to today's dollars. The pieces that are connected with the long-term side of the calculation are temporarily suspended, dropped onto your balance sheet and amortized over a closed number of years. So what it's attempting to do is to smooth out the pension expense hitting your income statement so that your income statement isn't going like this every year. Because if you have like a 1% change in the discount rate that the actuary uses inside his calculations for a pension system this large here can swing your liability by millions, okay? So we temporarily park certain pieces of that calculation onto your balance sheet to smooth out the impact that hit your income statement.
Is that done on a fiscal year basis, or how much time can that be carried for?
It's for the closed years, for the deferred inflows and outflows, it's approximately 5 to 6 years. So that's how it's smoothed out.
Interesting.
Yeah. So in any event, it's kind of confusing. To me, I think it would have been better if they had just left those pieces all in the notes and just brought one piece forward, because the whole thing's an estimate to begin with. So anyways, no change in how we've been accounting for any of this stuff for the last X number of years, okay? We do have something new on your balance sheet. This is called the leases receivable. There was a new standard that came out a couple of years ago called GASB 87. And GASB 87 said that it doesn't matter if you have a capital lease or if you have an operating lease, all leases are required to be reported on the balance sheet. And it doesn't matter if you're on the receiving end as a lessor or on the payer end as a lessee. Right now, for us, we're on the receiving end because we rent property here in this building, over 8,000 square feet to the
School.
to the school district. That's exactly right. Now, GASB 87 says that when you take a look at this lease obligation, you have to take a look at the initial term, and then you also have to look at the extensions that are offered to them. Even if they would have to it would have to be almost certain that they weren't going to exercise the extension. So we have to pick up the extensions in this calculation. So what we do is we factor out all the lease payments that you're going to get, and we discount it all back to today's dollars, and we drop a receivable on your balance sheet, indicating to the reader that this is what you're approximately expecting over it. Now, how we offset that, because we're not going to have the cash for future years, we have a new line item that comes into your deferred inflows of resources called deferred inflows related to leases receivable, the payment of future rent. Okay? It is a lot, trust me, it's a lot of accounting we had to go through just to figure this stuff out. But anyways, the ultimate goal of it was to get this stuff out of your notes and drop it onto the face of your balance sheet so that it became more transparent to the readers of your financial statements for the selectmen. So that's it. And really, this is really being driven because the public sector wouldn't actually disclose their true obligations in their notes for the operating leases that they have. And it's unfortunate they didn't. They should have applied big gap and small gap in this case here, but they didn't.
How does this is the Financial Accounting Standards Board that comes up with these GASB.
Yeah.
I mean, how do they really think that a line item like this helps anyone to understand what the financial health of a community like this is? When you're dealing with, you're actually putting numbers on lease options that may never be exercised.
Yeah, and it's a shame. And the answer that I have to that is I have no idea. But the FASB and the GASB, which fall under the AICPA, they are passing standards like this at a record pace. It's ridiculous. I mean, they're passing them so fast that Joe and I don't even have the opportunity to read them when they're even released. Usually we're reading them in the year that they actually go into adoption.
David, they get paid on a piecework basis?
It's the modern day version of ERISA.
Yeah.
It keeps everybody employed.
Yeah.
It does.
I hate to say this. I was taking a CPE course and a comment like that came out of somebody that sat on the FASB board.
You weren't on the
I kid
FASB
you not.
board, were you, Ed?
Well, not at the time.
But that's how they look at it. So in any event, that is new. The idea is to let you know that you have big lease obligations. We're on the receiving end to it. Whether or not you get the full $1 million if they decide to exercise their extensions, I guess we'll find out when that happens. If that does, the good thing about this is this. You have the asset, you have the deferred inflow. So the impact to the town's net position is minimal. All right. So it's really a note disclosure stuck on the face of your balance sheet. Okay. That's probably enough about that, right? So capital assets, $33 million. We did have $2.3 million of additions. We did see all of that stuff. We didn't have any issues in regards to any of that. The additions that we had, police cruiser, highway garage improvements, wastewater grinder, highway dump truck, bridge replacement projects was the biggest one because we had that one ongoing, and Park Street pump station projects there. So we had those, and we didn't have any issues in regards to any of that. All the invoices were fine. They were recorded properly in your accounting system. Everything was okay. Payables was all fine, nothing unusual. The debt, we paid down our normal debt obligations. We pay $1.3 million in principal, about $275,000 in interest costs related to that. So debt service is about $1.5 million. We did have new debt come on to finance 3 new projects, about $1.4 million. So we're now sitting at about $10.5 million of total debt. Okay. And then our net position is the difference between our assets and our liabilities. It gets us to a net position of $35 million. We break that down into a couple different pots. What we have tied up into our infrastructure, our assets, our buildings, our vehicles and equipment, that's at $22.7 million. And then we have money that's restricted that has specific spending. So for like the CPA funds, the capital projects, special revenues, and your trust funds, those are restricted because you got to spend those on certain things. And then everything that doesn't fall into there falls into that unrestricted column, 7.3 million. Now, it is good to know, which is very positive for the town here, to show you that you're good financial position for the town, that usually with the recognition of OPEB, other post-employment benefit liability,
Yep.
that's exactly right. And with the recognition of net pension liabilities, that unrestricted in almost every town that I look at is a negative number because of those.
Well, they have the liability and very few
Yeah.
towns fund for OPEB.
Yeah, and I was just going to say that the town has done a very good job because you're very well funded with your OPEB. You have, you got quite a bit there, actually.
3.7 million and change.
Yeah, $3.7 million.
3738
Yeah,
million.
that's exactly right. So the town's done an excellent job with funding its OPEB.
I have a question on the OPEB.
Yep.
I don't know if that's concerned in here. We have 3.7 plus million dollars in there. Other towns have not financed very little, if anything. What happens if OPEB goes upside down? Will that affect our Stockbridge employees as far as the money we've donated? If there should be something that would cause that OPEB fund to go upside down.
You mean lose a tremendous amount of value? Well, as far as I'm aware, the town's not actually drawn any money out of the OPEB to cover the insurance, the health insurance premiums that you're paying now for the retirees.
Okay.
Okay, so it's not, you have the assets set aside to obviously cover the
Exposure, the liability.
Yeah, but those assets
Yeah.
that we've set aside are for our employees, right? But it goes into the Berkshire County?
No.
No.
Okay, I
No.
misunderstood
This is a
that.
separate
Got it.
fund.
Okay.
Separate designated fund.
And I thought you,
And
That's what I wanted
we
to
need to talk more about that afterwards, but
Good.
No,
Okay.
yeah,
Thanks.
and we confirm the value of those assets. Those assets are under the town's name.
Good.
Right.
Okay,
So, yeah,
Great.
In a state fund.
yeah,
you
that's
can't
exactly
go
right.
from, correct?
and it's based on confidence level, it's based on,
Yeah, there's a
the
investment
demand.
policy that the town
Exactly.
has.
This gentleman is an actuary here.
Are those assets on the balance sheet?
It's on the balance sheet in the form of reducing the overall liability. Okay, so inside the
Netted
notes,
out of the 840, out of the, well, that's the net pension asset. There's on the OPEB,
yep.
on the 776,
So there
it's
is,
netted out of that.
there is, if you want to flip real quick, this will answer your question. Flip real quick to, I'll flip real quick to page 34,
I don't read that page.
okay? You can see that on page 34, you got the total OPEB liability on the left-hand column, 4.1 million. So there's an actuary calculation that comes up with that estimated liability. Then we have your assets, which you have on deposit at Bartholomew, I believe. $3.738 million gets us down to a net liability of $383,000. That $383,000 is back on your balance sheet on page 7, right there under non-current liabilities,
I see
net
it.
other
Yep.
post-employment benefit
Yep.
liabilities. So it's there, it's just a
Netted.
reduction against the liability. Yep. Yeah, very good question. Thanks. Okay, so let's move on. I gotta pick up the pace here for Anya. So let's move to page 9. Page 10, or page 8 is the income statement on a full accrual basis. It factors in all those adjustments, and it's kind of confusing to look at. It starts with expenses, applies revenues, and gets you down to the net. But I can get you there the same place that'll make more sense when we look at 9 and 10, okay? So page 9 and 10, if you were to focus on any pages inside your financial statement on how closely you guys budget in regards to resources in and resources out, page 9 and 10 are the 2 pages. Because if you were to print the reports out of your accounting system, they would closely, almost identically mirror this, minus a couple minor adjustments that we make for some accounting pronouncements, okay? But you're going to see on page 9 and 10, and this is called the Uniform Massachusetts Accounting System Rules. It's the modified basis of accounting. That's the rules that the state of Massachusetts uses, which we follow. Cash is always cash. Receivables are going to be the exact same. Payables are going to be the exact same. One of the minor differences is that deferred revenue revenue not considered available. Massachusetts says that if you don't collect your taxes, we're not going to count it towards your fund balance. So whatever we have up in the receivables, we have to have a corresponding offset in deferred revenue. We make one minor adjustment to that number to reduce that deferred inflows and bring an additional revenue into the town for the 60-day rule, because Massachusetts does say that if you collect your taxes within inside of 60 days at the end of the year, you can count that towards your fund balance. And we make that adjustment. Okay. And then your total assets minus liabilities gives us our positive net position of $13.5 million. And you can see we break that down into the various pots, restricted and unrestricted, no change in any of those. And then that bottom right-hand corner is the conversion from the Massachusetts accounting rules that we follow back to the full accrual basis financial statements. So you can see we get from 13.5 million all the way up to 35 million when we figure in the fixed assets, the OPEB, the net pension liability, all the debt. And that 35 million agrees right back to your page 7. Okay, and that's how those two statements tie together. But outside of that, your regular assets, cash receivables, payables, is exactly the same. Page 10, we did $14.4 million in revenue. No issues. Everything was fine when we tested your revenues. We did $13.5 million of expenses. Everything was fine with the expenses. We traced to a lot of invoices. Everything was fine, recorded to the proper accounts and to the correct funds, so everything was okay there. So that gave us a surplus for the town of $900,000. Then we had some debt borrowings that came in, and we have transfers in between the funds, okay? And the transfers don't net equal out because the transfers out are more than the transfers in by about 50,000. And that 50,000 was a transfer that we had made over to OPEB, right, Joe?
Correct.
Yeah, that 50,000 went over to the OPEB plan. Okay, so that's what that one there was. So outside of that, the town had positive surpluses for the year. We'll bypass page 11 because that's another reconciliation. Let's go to page 12. So 9, 10, and 12 are the 3 pages are, to me, the most important pages that you would want to focus on as a board member. Page 12 is our budget versus actual. So you can see surplus over budgeted revenues of 900,000 and underspending of our expenses for the town as a whole, 700,000. So we know that the town's not allowed to deficit spend unless it's snow and ice. Obviously, we didn't have any of that. And the town stayed within inside the confines of the budget that the selectmen voted to put into place. So everything was good there. Page 13 is the OPEB fund, which we already had talked about. And page 14 is just the change in that OPEB fund of what happened. And the comment that you have made about December, or this is at June 30, 22, so the investments actually dropped. So you can see we have unrealized losses. The difference between fair market value from one period to the next. It's not realized, it's unrealized. So as long as you hold the investments and the stock market bounces back, that number will go in an opposite direction in a future year.
Pretty big if.
Yeah, I know, yeah. Okay, so kind of moving forward, this will go a little bit quicker now. The notes to the financial statements start on page 16. Accounting policies that we followed last year, exact same accounting policies that we followed for this year here, minus adopting the new GASB lease standard, okay? So we can skip, because all the disclosures are exactly the same as last year. So we can kind of move in. Okay, let's move into page 22. And I just kind of pointed out that the town does have $2.8 million of investments. And this is where these come right off your investment statements. All right. And that's where they're invested. And then right down below that, you can see where those investments are within inside each of the funds. We got money inside the general fund, stabilization fund, and then some of the various trust funds. Okay. But everything was fine there. Kind of moving forward onto page 24. Is the new lease standard. It actually starts on page 23, but the numbers are on page 24. And the two big leases that you have that we picked up that met the definition of the GASB 87 was the school leasing space from us upstairs. And then we also had a land lease over at
Is that the cell
the
tower?
Glendale Middle Road. Is that the cell tower, Joe?
Cell tower.
Yeah, that's a cell tower, yeah.
And the solar.
Okay.
Yeah, the solar.
And these payments here obviously come out of the lease agreement. Obviously, we factor in the extensions, whether or not that they exercise them or not, but we're required to do that. And then as we use a discount factor, I think we use what, 4%, Joe?
4%.
This seemed to be okay. And then we drop those numbers onto your balance sheet. Kind of moving forward, onto page 25 is the fixed assets. Okay, and everything was fine with the fixed assets, but we did add a new disclosure at the bottom of page 25. And that's because we have a lot of money tied up into construction and process. So if you look at the top, we got construction and process projects ongoing at $3.7 million. Okay, and then that's an awful lot of money to have tied up to not tell the reader exactly what the projects are. So Joe and I decided to add a little blurb down at the bottom, letting you know of what happened with the projects that were ongoing, the ones that we had increased cost decreases, and then the ones that were completed, and then the ones that were still ongoing. And obviously the biggest lion's share of that is your bridge replacements. So, but everything was fine with that. Page 26 is all your debt. Okay, everything was fine with the debt. You guys made all your payments all in time, so we didn't have any issues with that. And then we did have some new borrowings. Okay, so $10.5 million total in debt. And then I think that kind of moving forward, let's move to page 31 real quick. And then that bottom half, there's we got the Berkshire County Retirement System there. This stuff comes right out of the Berkshire County Retirement System reports that we get, okay? And you can see that their projected obligation at December 31/21 now was $335 million. They had plan assets, $358 million, which gave them a net pension asset of $23 million, okay? Our proportionate share inside that entire system is about 3.6%. So 3.6% of that 23 million is at 845,000. And that 845,000 is the number that's sitting in the net pension asset on our balance sheet. Okay. Now, we're not required to have that Berkshire County Retirement System numbers there, but it's kind of hard to tell the 845,000 when you don't have what is, you know, what is coming out of. So we've always decided to add it.
Good.
And then page 34 was the OPEB, which we had gone over just a few minutes ago, showing you that we have a pretty much almost fully funded. You know, you change your discount rate, if you increase it, that thing goes away. You can say, oh yeah, we actually do, we run it down below. So if we applied a discount rate that was 1% higher at 7.41%, that would have pushed it to a net pension asset, OPEB asset of $92,487. So it's all an actuary calculation, but it's reasonable, it's within the ballpark. And then I think that's pretty much it. The rest of the schedule is just kind of talk about various statistics and multiple years. We're required to have eventually 10 years of statistical information on the OPEB and the net pension, so we can see the trends. And right now we got about 5 or 6. And then the last pages there that go landscape on you just gives you information on all of our non-major funds. But those are all consolidated and included in a non-major fund way back at the beginning income statement. And this just expands the details so you know exactly what it was: federal, state grants, water, sewer, and all the like. That was a lot. Yeah. Okay. So that's the audit. Good, clean opinion. We did have a couple management letter recommendations. These aren't findings. They're just recommendations. We had one with the reserve fund. There were some transfers. The reserve fund was used, and I guess instead of instead of altering the budget, the reserve fund, the use of the reserve fund was pushed through the actual expenditures. So we had some budget items as an actual expenditures inside the actual expense accounts. And we chatted with Mike about it, and we chatted with Cheryl and with Erica, and they saw what we were pointing out, and they're like, oh yeah, that makes sense. So going forward, if there's use of the reserve fund that's going into other departments or other line items, it'll be applied through the budget column as opposed to the actual expense column. But in the grand scheme of things, even if it wasn't cut, it was very immaterial. But it's good to know, good to keep that accounting policy correct. The second one was there was some bond premiums that were received on the borrowing of the debt. And the bond premiums should have come into the capital project costs where the debt came in, and it was accidentally dropped into the general fund. So we had recommended that Cheryl post an accounting adjustment to move those. And she did. She made an adjustment. We accounted for it properly on your 22 financial statements. She made an adjustment in fiscal 23 to move it over to the correct fund. So we'll be all squared at the end of June 30, 23, and that was all recorded properly. And then the last one, hey, GASB 87, it's the longest one. Look at that. To say you really should adopt an accounting policy for the GASB 87. We offered some suggested language to the town. They're going to include it inside your accounting policies and procedures manual. And we'll probably track the spreadsheets going forward.
And you have discussed these with Cheryl.
Oh, yes,
Cheryl Allen,
yeah.
so she's,
Yeah,
Michael's aware and
Oh,
Erica's
yeah,
aware.
yeah. I actually had phone conversations with Erica and with Cheryl.
Perfect.
And then Cheryl called me after she made the adjustments back up, and she chatted with me about it again to make sure it was all fine. And she did everything right.
Excellent. Thank you.
Okay, so outside of that, we do have another letter which goes to the board. Just to kind of point out that there are some material estimates that are inside your financial statements, net pension liability, OPEB. We looked at all that stuff. Everything was fine. We had no issues in doing the audit. It was actually very nice doing this audit. So we don't have any issues with dealing with your management. We never have any issues with getting the information that we request, and everything's always given to us timely. So everything goes pretty smooth. So that's what that last letter says, that we didn't have any issues. There are some accounting adjustments that we do. We convert your internal trial balances to what you see inside your financial statements in the GASB 34, and it's probably about 3 pages of entries. But the management is fully well aware of what those entries are, and all the entries that we do come right from your accounting records. So. And I think that's pretty much it.
Anybody have any questions? Is there any, do we need to take any action on, at this point? I wouldn't think so, right? Yeah, okay. You're just to approve the draft or anything, but, okay.
Yeah, now, because you have your select board
Yes.
approve the
Yeah, they-
financial statements based on your, okay,
Correct.
so we'll have to wait for that.
Yes, correct.
Okay, that's good. Yeah, so I think that's pretty much it. So as soon as we get that, okay, we'll finalize all the documents and get everything submitted up to the Division of Local Services. These are required to go to Mass DOR. So they'll go up with another clean opinion for the town.
We thank,
Congratulations, Mike.
Yeah,
Okay.
yeah, very good.
That's,
we thank you for your efforts. You know, you've been extremely supportive and helpful to our operation.
Oh, yeah. no,
Multi-year,
Yeah, more. Joe bears the brunt of it all.
I'm sure.
I get the easy stuff, right, Joe?
Thank you.
Yeah, no, you're more than welcome. So I guess we're all set?
Yep.
Okay.
Thank you very much.
Well said. Thank you.
40 minutes, we
Wow,
kept it down.
good to see you both.
Good to see everyone.
Any questions, feel free to email me. So. All right, ready? All right. All right. Well, it's good to see everybody.
Thank you.
Make sure the trip on wires getting out of here.
Let them get settled up and then we'll move on, Michael.
Good job.
Got a good financial view.
Do our best. All right, you guys have a.
Okay, the next point is the operating budget.
Thanks, Erica.
Okay, everybody has received, thank you, Erica. Everybody has received a revised copy of the operating budget.
So I'm going to start right now. If everybody takes a look at this, I highlighted, there's just a couple areas where we have some changes. The first change you'll see is under Selectmen's expenses. It's been reduced by 37,500. The Selectmen met and we discussed specifically the litigation line. The litigation line was, used to be $100,000 last year, it was reduced to 85, and we're proposing to reduce it to 30,000 this year for this budget. So far, even though we budgeted 85, so far this year, we've used $2,611 out of that line. So we thought that there's really no risk. We have no litigation pending right now, so we don't see a reason of running a large number there. So, like I said, that was an adjustment made by the selectmen since the last time. Glendale solar maintenance is the other highlighted one. You'll see that down. We're reducing that to 5,000. That's because the highway took over the mowing part out there. Outside of the solar field. We used to contract that out, so that is taken care of. The other one on the second side. If you remember last year, we proposed to set aside $1.2 million to pay off this building and the water treatment plant debt in case the new school came on. Well, the new school is not going to come on until at least 26 or FY 27. So instead of carrying that debt for the next 3 years on the taxpayers and just letting that other 1.2 million sit aside, proposing to take it and pay it off. Payoff amount is $1.198 million, which will leave 44,000 in that stabilization account. And we would still have, and this goes to the other budget seat, this would still have us having in stabilization $1,071,000. So we still have over $1 million in stabilization. We've had over $1 million, 1.8 million in free cash. So we're still in tremendous shape. So we thought that those two line items were there. And that was actually, Patrick proposed that because we're both on the finance and the schools, regional school discussion. So we think that we just might as well pay it off now that we have plenty of reserves in place. So those were the significant changes to the budget that were reductions in the budget. The select board's pretty much gone through the rest of this. Now, we still have a couple questions that we're still working through. And the one that I did forget to highlight, and I apologize for this, is fire. There's a discussion happening right now of whether or not the town should bring on an additional firefighter during the day, in addition to the chief. This will be a firefighter EMT position. Right now, this budget that you have in front of you has that in there, the position, and it's on the firefighting tab. You know, one thing I will correct for next time, and I realize I apologize, I did not number these pages. My fault, completely my fault. We have brought in that position into the budget. So the board hasn't made a final decision, but they were curious to get any feedback that the finance committee had. And this is possibly one that we might want to have a department meeting, a joint selectmen fire meeting to discuss this issue moving forward. So
What's the amount? I'm not seeing that for whatever reason.
So it's a color tab.
What tab you're on?
Yeah, like I said, I apologize that I didn't number these because it would have been a lot easier as we're flipping through. So it says, it's just after police, it's
60, it's the salary line, it's a difference of 68,330.
right. But I have the breakdown, you can see where it says, full-time firefighter EMS. And, you know, the position would be with overtime is, approximately 54,000 in pay. And then when you add in all the benefit costs and everything else, that actually gets closer to about 90,000 altogether. One of the weaknesses that we do have is we don't have a large response during the day, during the work day, when firefighters are at work. So this is one of those that's been brought up as a possibility to consider as we consider what's happening. We have a working group that's going to be starting in April, looking at the possibility of the services being combined with Lee. But we have to also keep working on almost two lines at the same time. We have to work developing a plan that works with Lee, but we also have the other plan that has to be what happens if it doesn't. So we can't wait 2.5, 3 years and just say, oh, now we don't have a plan because the Lee one didn't happen. So we're gonna have two lanes operating at the same time as we move forward.
Two comments on this. Number one, the first comment is, I think it would be appropriate to discuss this at a joint meeting with the select board, okay, the fire department. Number two, and if we contemplate at a point down the road of future position, this would be not a permanent position on the budget. It would be a renewable position, perhaps on an annualized basis.
Yeah, we make sure to protect the town, knowing that we have these dual issues happening. And that would be in any labor agreement that we'd have with the person coming in. They'd have to understand that we are exploring this formation with Lee and that there is the possibility. I mean, we are an at-will community and an at-will state anyways for hiring, but we want to make sure that.
Just for the record.
It could be a contracted position. We're looking at the
Yeah.
different options that would be available.
Well, perhaps it'd also be possible moving forward to the positive side of the combination of having this employee be absorbed into that operation.
It very much could happen because anybody we bring on, we want to have them firefighter / EMT, and there's a shortage of EMTs anyways. So, yeah.
But the thing is, we don't want to get ahead of ourselves. You know, we don't want to commit the town to something that we don't know what the end game is.
That's understood.
Yeah.
That's a dual path. It's going to be a little tricky over the next couple of years figuring this out. So
And this person is just for the day?
the shift would be during the day. Yes,
Right.
it would be part of the day shift, which is our weakest point that we have right now. It's a Band-Aid on it while we figure out how we're moving forward.
When would you contemplate doing this joint meeting?
I would we have to have everything settled by April 27th for the town meeting that Thursday. So possibility of maybe doing it April 13th with the selectmen's normal scheduled meeting
Good, that's a good day.
Or the 6th if you want.
or the 6th.
Okay,
It was good for you. Well, big time.
good dates.
That's a Thursday, right?
Yep, both are Thursdays.
We'll canvass the committee.
Yeah.
Okay, anything else on that?
I have one.
Jim?
Yeah, well, I have a question. I recall last year, under the police budget, the police chief was talking about the possibility of adding another officer. And I just wanted to know where that stands.
So we did add that last year to the budget.
Right?
And-
There was talk about
Yeah.
another one.
Yeah, no, we're not, because we weren't able to fill the other one.
Somebody-
It's been, we had a couple rounds here going back and forth on trying to get the position filled. So we're still working on that. So there's no need at this point we see
Okay.
for any further police expansion.
So the benefits are also, if we did do this fire EMT, are in the benefit line?
It is, we always carry an extra position just in case we add one. It also makes sure that we never end up short on our benefit line. So we'd be able to plug it in there.
I mean, there's healthcare and
Yep.
so forth, right?
Right.
Correct. Okay, anything else on this? So more to follow on this particular.
Diane?
One question. How are you doing with the volunteers?
So right now we have 19 listed firefighters. We have 16 active firefighters. And out of those 16, there's 8 that do most of the response. So
We better hope the red line doesn't catch on fire.
we have 8 that,
Mutual aid.
8 that do a little bit and then
By the
3
time they
that
get
are-
here,
No.
No,
Not
the
Is
response.
that acceptable?
We're better than some other communities out there as far as our numbers right now, but we do have concerns about the numbers going forward. And that's what we're looking to address in this next couple of months, where we have a working board that's been established that's going to be looking at what we do going forward.
There's also mentioned mutual aid, that
Yes.
the whole burden does not fall on 8 volunteers, for example.
On any individual volunteer fire department in the county, there's an intricate mutual aid system set up. But it is generally recognized the most difficult time of the day for response, mutual aid, and everything else is during the work hours, during the week.
Anything else on this?
The 8 that respond though, are they employed during the day? Are they the ones that are responding during the day?
Which one?
You said out of the 16 active, 8 did the most responses. Are they day and night or are they just?
Mostly night, weekend.
Yep.
Yep. The day responses typically are chief with maybe 1 or 2 other firefighters.
Of the structure fires that we've had in the last 5 years, Pam, they've all been fought by mutual aid.
And no department, to be honest, no department is set up for a major structure fire to fight by themselves. It is a mutual aid
Yes.
response.
But the capabilities have to be accessible, through mutual aid or an independent full-time department or whatever, hypothetically. Okay.
I have a very minor question about this budget.
Yep.
Just because I want to offer $10,000 off of a line item. Where is rest of the river in all this?
So.
It's a good question.
And actually, I was going to ask you that because we have typically done rest of the river out of free cash. We've done it the last couple of years.
Yeah, I know you funded it out of free cash, but was it voted that way?
Yeah.
As a
It's been a free
item.
cash and we set
as a
some
line
money aside.
item, but as a separate line item. It was voted as a separate appropriation out of free cash.
Yes.
Okay,
Do we need another appropriation this year? I was actually going to ask you that.
but cut it by 10.
Cut it by 10.
Yeah.
All right. Yeah, because I think it was 35.
It was 35, cut it down to 25.
All right, that goes on just the warrant for town meeting?
Yes, I
And
know.
I will add it to the free cash
Want you to know it,
tab. All right, yes, that was one of my questions. I was going to call you on, but
that's okay.
That's a good point.
I have a question. Are we going to talk about OPEB now or later?
we will talk about OPEB in 1 second, if that's all right, because I'd like to just go over the salary sheet. That's like your 3rd sheet in. What I did is in order to clarify, so at the last meeting, we sort of went quicker than I thought. And I just wanted to clarify a couple things. So the 24 increase, what I did is I applied a 2.5%. And what I did is I shouldn't have done it, the way I had it set up last time, I had all of it in one column and I shouldn't have done that. So you'll see that I broke out the 2.5% increase. And then I have some additional increases highlighted in blue and then the ones in yellow. So let's first review the ones in yellow. So obviously the easiest column is the 2.5% column. That's just 2.5% calculation everybody gets. The yellow one was the duties that we had split up from when we eliminated the facility director position. And I took all the duties of the facility director and split them up among the departments. It ends up being about $22,600 total of wages. There are some, not just the ones that are here, there's a couple others under Jen and the building inspector line. But we took those and then we were able to eliminate a $60,000 position with benefits and that. You know, I will say the reason why we were able to do that is Chris left us in great shape and had it all well organized. And what it did allow us to do is just, I couldn't have given it to one person, but what I did is I split up everything. So I have some that are taking care of the leases. I have people that are taking care of responses by groups, whether it's if there's an issue with the elevator or whatever, you know, so we split up the duties. It allowed everybody to get a slight increase in pay, but overall last year, it allowed us to do the thing. What I did last year is the 2,600, I didn't want to put in anybody's salary yet because I wanted them all to try the positions I asked them for and then make sure that everybody was comfortable with it. So we did a year, everybody's comfortable with it. I think it's working excellent. I don't see where we have any deficiencies. So I'm recommending that now those dollar amounts go directly into their pay. You'll notice in the blue column that what I am proposing to do is I want to maximize the efficiency of some of our staff. We have been able to trim down the staff, but we've also have some excellent people here. But what I want to do is I want to include some additional training. That includes having some people trained in the basics of assessing to be able to assist in the assessing department, take procurement classes so they can handle the smaller procurements between the 10 and 50,000. That would lift that off my plate, but would allow me to focus on those that are 50,000 and greater. And what I want to do is reward the employees with, as they receive these additional duties that, and these additional tasks, that we reward them on that. And I think overall, it just makes for a better organization from top to bottom, that if we have this training. You know, I have one employee that'll take on the maintenance district that we just accepted, the Beechwood Lenstock one. I should be talking that I want to put Erica over both the accountant and the assistant treasurer and more use her as a financial officer for the entire thing. Those are just the ones that I'm recommending. These would be built onto their base pay. It also lines up, my financial team that would be in green. The support staff is in orange. You can see that under their 2023 base. And I do think that it is puts them where I think they should be clubbed as far as if we don't really have a pay structure for the positions here, like pay scales and stuff, but it puts those positions that are similar there. And of course, there is the request from the clerk. As you know, the town clerk is elected, and I included her letter that she submitted. Overall, I think it's my recommendation on those. So if there's any questions on those.
I have a question. It doesn't look like the clerk got a 2.5% increase for 24?
No, she's just asking for, she requested a $6,500 increase. And that flat increase to her position. And the letter's there, and I'll send around a new email one where you can see, you can blow it up and see, but I know it's a little hard to read the letter explaining why she thinks that position should be reset there. So.
Is this the letter that's in small print here?
Yeah, it is. I'm sorry. I tried to do better this year about making these easier to read, but they're still difficult to read. So I will make sure that's, all right, they're nearly impossible to read. So
Impossible.
I'm trying to trim these down to make them.
I guess I understand what you're telling us about the blue, but why wouldn't she also get 2.5% increase?
Well, because she's asking for a complete reset in her position. She's not taking on any extra duties or anything.
Well,
so hers is just a reset.
I'm not going to speak for her, but we all know that the RMV is going to cost her more time.
Yep.
Because we all have to check that box that says we're registered to vote. And so then she's going to have to double check all those.
Georgia, it's not unusual when there is a reset on a salary.
Well, I understand that, but still, I don't think it's fair.
That the percentage increase doesn't start until the following year.
Yeah. I mean, that it can be, I mean,
I suppose if Terry had asked for that.
Right.
yeah.
it'd be
Well,
one thing.
I agree with Steve from the standpoint that I can't read it, but I'm assuming that this is what she requested. If she requested this
Yes.
and it's approved,
But if
then,
she requested-
and then the 2.5 comes into play starting next year.
She was well aware of what she's asking for.
And that she wasn't going to get the 2.5?
Yeah, she was asking
Okay.
for the 6,500. Yeah.
That's the way I heard it.
Even more.
It's greater, yeah.
It's greater.
Yeah.
It's hard enough to understand it.
I think it's fair to say that Michael has excellent dialogue with all the key staff here. So, I mean, this is an ongoing situation.
Terry's not bashful either, man.
And
Okay.
overall, I want to make sure to protect us.
Right, you did.
We have an excellent staff overall.
Absolutely.
I think, retention of staff is one of the most important things during the current environment that we are in. And I think this rewards it as appropriate.
Okay,
Jay, I think we have a couple of things.
Jim?
I just was looking at this and something caught my eye. You had Liz Griglia as the COA scheduled for, at least she was getting, I think, 23,490, but she resigned or retired. Now you have Roxanne McCafferty in there
Oh, yeah.
for no charge, right? So she's doing that voluntarily, right?
For currently, but this is for next year's budget.
Okay. But that's what I'm saying. For next year's budget, we're saving that 23,000 and change out of,
No, we're not.
For 1 year, she couldn't receive a salary. That expires on May 16th.
Okay.
And she'd start collecting salary.
yeah.
Well, then why isn't it in here? Where is the base?
Yeah, why, good point. Why isn't it in there then?
I don't see it. Maybe it's just me.
What's that? I'm sorry.
I don't
Is there
see-
something I'm missing?
Yeah, we don't see the rate for 24.
Yeah, you got
It's right
The
here.
position was left at last year's 25. We didn't have anybody in it,
23,490 for FY '23.
Yeah,
which is 18 hours at 25,
Right.
25, and that's the hourly base. I wasn't making any adjustment. We didn't have anybody in that position. So I just set the position at $25 an hour.
For that.
Yeah.
Okay.
Okay,
Okay, now I understand what this.
what's next, Michael?
So those, I hope that, other than that, there were really no other changes. I know one thing that the select board did want to discuss was a policy for OPEB. So as we spoke, we're sitting at 96%. We were 103%. And most likely now with, with CDs and other things, savings accounts right now, interest rates are up on those. CD, we were able to lock a CD in on some of our other borrowings at 4.25% for 13 months, which is going to generate, as Patrick pointed out to me, is going to generate at least $70,000 next year in investment income, while we only had $20,000 the year before. But if we see that increase, one of the discussions should be developing an OPEB policy as we get above 100% funded. So once you're above 100% funded against the liability, the future liability, you can start using those additional proceeds to pay the current retiree portion, which would alleviate some of the burden on the taxpayers. We're not quite there yet, but I think we should be discussing at this point a policy of where do we kick off. I know me and Patrick had spoke earlier, if we get above 100%, do you then, if we're above 100%, do we then pay the retirees? So every 2 years we get our report done. So if we're over 100%, do we pay the retirees? And then over 2 years, if our investment income hasn't kept us above 100%, we could use free cash to put into that account to get it back up. It would still keep it off the taxpayers' back. So that's just something to consider. Where do we want these points? The funny part is, I looked at it and I know Patrick called around asking the MMA and some others, what's the policy? And they basically said, no one else is fully funded, so I don't think there's anybody else. So it's time to start us thinking about it. Yeah, I don't think it's anything we have to do tonight, but it is something we should be thinking about as we become one of the first communities to become fully funded. And
Fully funded.
if you read the actuarial reports over the next 30 years, it will be overfunded by 1.4 million. So, you know, but a lot of that's based on future earnings, just like Dave, our actuary, our
Question, Diane.
saying.
I have a question, Michael.
Yep.
Because Stockbridge is so well funded with the OPEB and the other communities are really kind of not.
Yeah.
What happens with that fund as it relates to the other communities?
Nothing. It only affects us.
There's no relation.
Completely segregated, I think.
No,
we're
I
talking-
understand that. Everybody puts in whatever those amounts are. But what happens with the other communities that do not have as much as what we would have?
If they have a run on the bank, they raise the taxes, basically.
Well, actually, it's not that.
That's the bottom line.
So OPEB liability it would be the liability if the community ever fully failed. And this comes from.
Not going to happen.
It mainly started in businesses where business could cease to exist, and then there were other post-employment benefits that the company was responsible for their retarees.
For example,
But FASB requires the recognition, but JASB doesn't.
Right.
And that, if JASB ever changed, then they would have to start pre-funding.
Yes.
that's right.
And right now, it's only recommended, it's not a requirement.
Those other benefits, just FYI, would be health insurance, dental, vision, prescription, things of that order, okay?
Mike, when you finally get around to developing the one-off policy on OPEB, please take into account Ed's remarks, which he made at the beginning of the meeting, about discounting whatever the principal is at a given moment, applying some discount factor for market risk.
Yeah.
So that 100% may not be 100% 6 months later.
Right.
And we worked hard to fund OPEB, and I don't think we want to see it spent too quickly.
The other thing, and we happen to have an actuary here.
Former actuary.
A former actuary. Obviously, the actuary comes up with a confidence level relative to funding. So basically, on an annualized basis, we get his range, if you will, or their range, he or she, as to a confidence level, so that we can move toward that direction, as opposed to arbitrarily funding.
Right.
I have a question regarding the actuarial figures. And I don't know if it's different from private finance to public finance, so I'll ask the question. What time period do they generally use to estimate whether the market is going to go down or up? And whether our benefit pot is going to go down or go up?
Well, the liabilities are projected to the end of the expected lifetime. And the assets are the assets that are, there's no projection on the assets. The assets are the assets, or they might be averaged over a period of years. But your assets are your assets, and your projected liabilities go out to the
ages.
To the ages. What isn't included are future employees.
Right. Plus what you feel wherever that money is invested, what the return on that investment is going to be.
That's the discount factor that's applied to the liabilities.
Right.
And ours is done on 30 years. Look out 30 years.
30?
Last report we
That's what I
had
was
out
asking.
to 2052.
Okay.
Showed about that. At that time, we'd have 1.4 million above what's needed.
Okay.
And that's based on their things. But it's every 2 years that they do the limit. 2 years ago, we were at 103% funded. Right now, we're at 96% funded because in the middle of there, we lost some revenue. So, yeah.
There's a lot of unknowns, like what's going to happen with Medicare, and therefore what's going to happen with those benefits. So there are so many unknowns that to be where we stand right now is pretty good based on what we know today.
Right.
Okay, anything else?
Well, I have one other question that came to mind when we were talking, and that is, as I understand, and I guess it'll be coming before us at some point in time, and that is with regards to where does the town of Stockbridge stand with regards to the Pinewood situation?
It's really not a matter for us.
Well, it
Jim. I
will
mean,
be. There's money.
I think, no, if there's going to be an appropriation, there's none before us.
Well, I understand, but I believe there's one being planned to come in from the CPC, correct?
I just have an open question though before.
And I'm not done with OPEB.
Yeah. Okay. All right, enough said.
We'll go to that
Get
one
there.
after the OPEBs. Let's,
OPEB?
Okay,
we have two people with OPEB questions still.
yes, Patrick.
So you mentioned the last meeting you had talked to the school. The school has a current OPEB liability of $94 million, of which I believe they use foundation enrollment to a portion. And I'm wondering if you're suggesting a policy in the town that we fund our share of that 94 million. I assume that you're not, of course, because that would be like $9 million. And so I just would kind of encourage us to recognize that in our most significant budget line item, we're budgeting OPEB through general funds going to the school, all right? And they've got over 30 years, their liability for OPEB is $250 million, whereas we have a net positive funding 30 years from now of 1.4 million. So I think it's great what we're doing with OPEB, but I also think we should have this conversation now, not next year, not 2 years now, about what our policy is, because the taxpayers paid that money into it. And I think they did that with an expectation that at some point when it was funded, they wouldn't have to basically double pay by putting it in the general fund.
Well, right now, you heard the David Irwin say that when we are not fully funded at this point, you know, there still is a gap there.
Yeah, right. But we all know that obviously it's all based on predictions, as Ed rightly pointed out. In fact, I think he'd be excellent to help us develop this policy. You know, these are all just assumptions on how much the money's going to make, how much it's going to cost, what the benefit levels are going to be. You know, there's a lot of, we're pretty close to fully funded here. The school committee is a disaster. You know, I mean, in terms of OPEB.
It's not something that I realize, but if we have a implicit, maybe explicit policy to fully fund our OPEB liabilities, but we haven't, because as you point out, that's a piece of our OPEB liabilities, which is off the books. But if we have a piece of it legally, do we?
Well, that's why I went out to talk to David. You know, in terms of it doesn't flow through to us, but it flows through.
And there's,
like Michael said, if the school district were to fail, there would be liabilities we would all have. It's unlikely, you know. But it doesn't show up on our balance sheet.
I think as far as where we are at this point, we're looking to fully fund the OPEB liability.
But for our own,
For the town.
for our own
For
employees.
the town.
But if we have a
The
responsibility.
schools are a different situation.
They're a separate district.
Gentlemen, do we have one?
Right, but do we have a liability to pick up a piece of that?
No.
We don't.
No.
It doesn't flow
But it would
through
be,
to any, to our.
but it could get very interesting if you ever had a regional school district fail. What would happen?
Well, theoretically, the demand on the liability of a failing school district would be allocated to the participants. Okay, those liabilities can come back to the participants.
But when we're allocated a piece of their budget, implicit in that is a piece of the OPEB, is it not?
No, they don't fund it.
Well,
Well, no, but it's
No,
pay as you go.
They
and
pay as you go.
It's expensed.
Yeah.
It's expensed.
Right.
Is the correct,
Yes.
right, that's correct.
So,
And if GASB changes the point of the accounting for the school district, then that's that.
so the only time that a school district has come close to failing, I believe, was Lawrence. And what happens is the Department of Education comes in and takes over through receivership.
That's right.
The school department, and they ensure that the system is set up, and they make cuts that a lot of times it's cuts that the school wouldn't have made, and then the state comes in and it can be draconian what they need to do, but they will reset the.
I'm not anticipating a failure of the school system so much as saying, do we have an implicit liability that we don't see?
Other than
That's my
pay as you
question.
go.
Yeah.
So my question is, on this budget, these sheets,
Yep.
haven't we added to this OPEB, but it doesn't show?
No, so the recommendation from our actuarial was, originally they had said we might want to consider putting 50,000 in, and then they actually came back because of the way interest rates are right now on savings, CDs and the rest. The recommendation is not to invest anything else. They're expecting us to end up above 100% funded. So right now, we don't need to add to it. We would just let in the next year, the interest take care of raising us back up. Because it was the negative on our investments that actually brought us from 103 down to 96, and now they're expecting it to be reversed.
Wait till next year.
Yeah, well, we all know that's looking at the market right now, not, yes. They're all
It's a
predictions.
little volatile.
But the prediction right now is not to invest, that interest rates should allow to restore it.
Okay. I'm okay
Okay.
with that then.
Anything else, folks? Anything else, Michael?
Not as far as the operating budget, unless
So-
somebody has.
Just a question, as far as the procedure is concerned. So other than the fire department,
I think it's good to go.
the rest of the operating budget has now been approved by the Board of Selectmen?
No.
No.
I mean, I just want to know.
No, they haven't.
4 items.
It has not been.
The fire truck purchase,
That's not a budget.
That's not in the budget.
I understand, but it's a decision point that we want your input on.
No, I just,
So we don't want to,
my question is about, excuse me, I'm addressing the chair. My question is about the operating budget. That's all I want to know.
So
They haven't approved it.
They haven't approved it. That's all I want to know.
Correct.
right, they haven't made final approval. But we are, other than fire, I'm not aware of any other operating budget decision.
I mean, where are you going to put Granicus? Is it going to be an operating or a
Capital.
free cash?
Capital.
Okay.
So when is that going to occur?
Right now, if we can, so for them to approve the whole operating budget, we need to tackle fire.
Yes.
So if we can tackle fire, it could be at the 13th meeting.
Okay, that's
And we
fine.
can finalize this budget.
Okay.
Good.
Anything else?
Capital budget?
Go ahead.
All right. So you have the newest updated sheets, capital. This should be a little easier to see than,
Oh, yeah? You gotta be kidding.
well, maybe not the debt one. All right, I'm misspoken. All right. I shouldn't have, I just realized that it flips the page when it.
It does.
Stapling, and that's
It's upside down.
yes. So if you flip it like this, it ends up
No,
in the right place. So what this,
still can't read it.
so overall, you can see our reserves at the start of right now. As of right now, we have 2.3 million total in stabilization. That includes 1.2 million to pay down the debt. 2.6 in free cash. Our OPEB, where we sit at, cemetery, ARPA, all the different accounts. What we are proposing in the capital, like I said, was to use the as a capital is to use the stabilization of 1.2 to pay down the debt on the town hall and the water treatment plant. So that's on the next 2 pages. So that would lower our overall debt. The debt one is quite hard to read. I apologize. We'll have to work on this again.
What interest rate are we giving up, or getting out of at that point?
We'd be saving 44,000 in interest. That's our total interest savings, because we only have 3 more payments left.
That's probably not enough to worry about one way or the other. I'm just, if it's a low interest rate, I would just carry it, given that you could put the money in a CD, meanwhile, and pay for it, but,
That is enough, yeah,
yeah, I mean, if you have 2% debt and a 3% CD,
yeah.
Don't pay down the loan.
But then it would still leave the the taxpayers paying.
Yeah,
By paying it off, we'd be taking off the operational budget, our debt payments. But you're right, it is a question to ask, that would we be better off to
That's why I asked.
1.2 million at, right now, we can buy a CD for 13 months at 4.25%, which is going to generate more than the 44,000 in savings off of interest.
There you go.
Yep.
there is another issue.
About it that way.
There is another issue,
Yeah.
and that is just simply being over-reserved.
That's why I was thinking about just
And-
using our reserves to pay us.
I mean, again, at least there's some of us who've believed for a long time that we're acting like a bank here and we're taking taxpayer money and being over-reserved, and we should be using the excess reserves over the 20% target
Yeah.
to pay down, whether we buy capital equipment with it or to pay down debt. Now, I grant you, you're right. I mean, if you do a pure interest rate calculation, this kind of environment, you're going to make money, more money.
Why doesn't that money inure to the benefit of the taxpayers?
Because the total amount of the over reserves is taxpayer money that should be used for taxpayer expense.
Right.
It should not be, we should not be acting as a bank. And that's what we're doing here.
We're proposing it would lower.
It's a
tax rate.
it's a philosophical issue. It's not a pure money issue. It's a philosophical issue that we have discussed.
I didn't do very well with philosophy in school, so.
Well, and I think it.
After math, I kicked.
No, I mean, add your point, you're absolutely correct.
I just raise it. I'm not trying to push one way or the other. I just raise it.
The whole idea of having too much money is weird. I mean, it's,
Well, I thought.
Okay, Michael.
This committee had agreed to that percentage
we
of
had,
reserve. right?
we had,
Right.
and so had the select board.
Yeah.
I'm not saying this select board, but prior select boards had also agreed to the 10 and 10. So.
Yeah, and right now, we're way above that.
Yes, we are.
So it does.
We're 30.
I mean, the one thing before I finalize this, we could do the calculation on what 1.2 million, how much that's bringing in, how much that would increase our investment income. But I think it's only around 50, 60, but it's not going to make up the 340 or the 400,000 we're taking off of the burden of the taxpayers. So, yeah, that's why we were making this recommendation to pay down this piece of debt.
Well, and the other reason, as you pointed out some time ago, is that to the extent that we can retire debt now in anticipation of having school debt, significant, capital expenditure in the next few years.
At a potentially higher rate.
Oh, there's no question it's going to be at a higher rate.
Right.
Everything's,
There is a question,
yeah, of course there is. We know that.
but, yeah.
Okay, Michael, what else?
All right, so we're not doing anything on the cemetery trust. Out of free cash, you'll see this is, like I said, I apologize for not putting page numbers, and I'm gonna make a note of that. If you flip over to free cash, it's right after cemetery. So we have the following free cash. One was that we ended up, I think I explained it last time, we end up with an extra interest payment in this year because when we took out the $4 million loan, we took it out so early that they were getting dinged with an extra payment because we had the months in this year where we had the loan. But we did that to get ahead of the rate increase back in that time. The fire department has requested $65,000 for turnout gear. Once again, this one will still be a fire department question, but that's still that two-prong approach. If in the next 2 to 3 years, we don't join with another department, we need to look at the turnout and replacing it. And then would that be something that could go into the next projects that we have? If we were to join with another community, how how would some of this play into moving with those assets?
But the best case scenario of joining together is at least what, 2 to 3 years away, isn't it?
I would say 3 to 5.
Okay, 3 to 5.
Yeah. In the 3 to 5 years, we still need to, right, we still need to continue to fund our current one.
You wouldn't consider doing it, or I'm just wondering, off the top of my head, consider doing it earlier without a building?
Well, that could be something, but without a building, now you get into where they're responding from, the call time, the call distance, and the rest. Obviously, the building itself where they're proposing to locate it is what made that attractive to,
South Lake.
because it's so close to our department, so. You know, without getting into that, just understand, we do have to consider two, what if it doesn't happen? We still need to, and we might during the process determine that it isn't in our best interest to do this. Right now, it's just something being explored by the working group that's going to be starting next month.
It's really premature, you know, we're,
Well, I understand that. I was just,
you know, there's no way we need to develop the thought more. It needs to be discussed further.
I'm still waiting for a final number from Highway and on the, I am proposing right now, I have a placeholder in there for 600,000 of free cash to go with the 645,000 of Chapter 90 money. So it'd be a $1.2 million reconstruction of many roads throughout the town. I'm looking to put 50,000 in engineering. We keep coming up with, all that's been in the budget before was $10,000. But at times we need engineering done on various in anticipation of funding a project. Once we fund the project, I build the engineering into it. Actually, it was something when I got here wasn't being done. So a lot of times the engineering, I was trying to scramble to get it out of one account or another. So what I'm proposing is we put 50,000 in for engineering, which would allow, as things come up, like we're not sure what we're going to do with the Curtisville. That's probably going to happen in the next couple of months, which direction to go. So by having some cash in an engineering line, I can then begin the work so that by next town meeting, we can have that lined up with what funds we would need to do whichever one. And then short-term rental, this would be the software that would allow us to automate our short-term rental. So we have right now, short-term rentals, we only have about 20 that have registered. We have a bylaw that says they're all supposed to, but unless somebody's gonna go searching on the internet for them, this is actually a software that would go out, they actually go out and search for the people that are advertising, and then they will send the notices for us to them. Now, part of that is, part of our bylaw says that you have to report to us, but you also have to give us your certificate that shows that you're paying state income tax or your state room tax. So this would be a way, even if we end up with 10 or 20 of them that aren't, that could end up paying for a good chunk of the software by itself. We want to try it for 1 year. That's why we're proposing to do it this first year out of free cash and then see where we're at and then see if it's a right fit for us. Great Barrington's using GoGov, there's Granicus, there's a couple others. So we'd evaluate which one to use, but we want to do a trial run of that for this year. And those would be the free cash ones that we're proposing. The CPC funds are listed here, the projects that they've funded. And I have the warrant pretty much done for town meeting. ARPA funds shows you what's been committed and then what we have a remaining balance. So right now we still have close to 300,000 in ARPA funds that the select board can apply to various projects. As you can see, we've done things from food programs to co-responder programs, a weatherization program. We did essential worker pay during the pandemic. We have charging station at Town Hall, 40,000, but we got a $50,000 state grant. So we're trying to do that. Stabilization account, like I said, we have 1.2 million. We want to spend it down. We'll end up with, that's the dedicated stabilization account, and it would still leave us with a balance of over $1 million in stabilization. Water, we're going to begin spending down those surplus accounts. Those won't be building as we've discussed from last year. The water department has some gate valves, purchase of a new hybrid truck for their department, engineering firm Elm and Maple specific wall main projects, new line analyzers and a water treatment interior painting job. That's a total of 166 that will come out of their surplus, still leaving them with a balance of 521. Ignore the next page because that's just all the requests, but they printed tiny. Let's try to read those. We did the next two pages are the water justification, and do I need to go over that again? Or does everybody understand how that's gonna work? All right. If there's any questions, we can.
Can't read it, but
I'm going to say something about that.
me too. See the font size here?
The sewer surplus is pretty much gonna be spent out after this year. We're gonna do the last phase 4 of the sewer surplus, sewer management program, the I&I study required by DEP. We're gonna do a sewer needs analysis. That'll be identifying where we should expand sewer in the town, sludge pump replacement, and then the overhaul of 3 wastewater plants. Once again, ignore the requests. They print out that way and they look way too small. Once again, there's the rate justification sheet that says, here's where we're at. One that if we're above a certain amount, we'll increase, and if we're below a certain amount, we'll lower the rate. I also included, just for your information, the Mass DOT Highway Division, Chapter 90, of which we have 654,000 in there. If we match that, like I said, with 600,000, we'll have about 1.2 million to go out and do significant road projects. Even at the end of everything that's in here, we would still have a total, we would have over 4.5 million in available balances. Stabilization and free cash alone would be sitting still at 25.41, which is still greater even after using 1.2 million to pay down that other account. We're still above the 20% that we've identified as our target. So we'd still be in great shape overall financially. So if there's any questions about the capital budget, I'm prepared to discuss.
Michael, I listened to you. I like what you're saying, but my comment to you is I can't digest stuff that I cannot read.
Yeah, I'm going to work on.
And at least I need to get that before we make any kind of vote at all. That's just my feeling. You've done a great job. I understand working with computers, but I think we need to get something in the font size so we can all read.
Well, what I'm going to do next time, what I'll do is print it out. I'll just have to print it out on the 11.
And the additional thing is, I would request that we get that, not when we come to the meeting, but we get it at least several days beforehand. Because I tried to go on the computer and read some of that. Even there, it's very difficult to follow.
All right.
So I appreciate what you've done, but I hope you can put yourself in our shoes when we have to. Thank you.
Tired old eyes, huh?
Well, you said your eyes were tired.
Okay, anything else?
No,
Anything else?
thank you.
Unless there's any questions, that's.
All right, so basically, let's just, before we adjourn, our next meeting, we're projecting on the 13th to deal with the fire department on a joint, to hear from the fire department on a joint meeting with the select board, okay?
Yep.
And then subsequent to that, whenever you have the final sign off from the select board, we need a separate meeting to address that.
Yeah, I believe that if on the 13th, we can come to final conclusion on the fire piece, that we can have it approved that night, and then probably by the following Monday, I can get an 11 by 17 paper final budgets to you guys approved by the select board, and then we can move toward you guys.
So it'll be on the 20th or 27th, somewhere on there.
When are we going to review all the warrant articles?
I will have the warrant articles on the 13th also, based on all the projected items, and then if there's any changes. So I should have everything done on the 13th.
I mean, because we have rest of the river. We have rest of the river as
Yep.
one that's not listed
It
as.
wasn't because I needed to get that answer from Steve, and I have that now, so that one will be added. And,
Okay.
yep, I actually have it in the warrant because I have all the previous dates and times because that one's getting lengthy, full line, but 25 to that one, yep.
Okay.
Any other business?
I move we adjourn.
So moved.
Excellent. 7:35.
All in favor?
Very good.
Thank you.
Thank you, everybody.